All right, everyone. Buck Joffrey here. We are doing this webinar today with George Newberry of American Homeowner Preservation. Now, most people who I'm sure if you listen to my show and if you are on this webinar, there's a good chance you do. If you listen to my podcast, you hear me talking about American Homeowner Preservation all the time. It is one of my favorite businesses. George is I've known George longer than I've had the podcast, and have invested with him on a regular basis. What I really like about this business model is it shows that you can direct your money and your investments sometimes in a way that doesn't just benefit yourself, but you can also benefit it towards socially impactful things, which I think is a pretty nice thing to be able to do. So given the fact that it is holiday seasons, I thought it would be great to have George on. He's got a fund that they are trying to close up here, and it's a great opportunity. I'm going to be in myself. So George Newberry, you want to take it over from here, George?
I'll do that. I appreciate your introduction, Buck, and I welcome everybody.
By the way, can everybody hear? Can somebody just can you guys just confirm that for us? Yes. Okay. All right. Go ahead.
Okay. Glad to hear. So American Homeowner Preservation, here's what we do. We purchase pools of defaulted mortgages from banks and hedge funds, and these are typically in low to moderate income neighborhoods across the country. And then we work with those families to find solutions. If they want to stay in their homes, we offer them, we share some of the discount that we get from the bank or hedge fund in order to reduce their payments, reduce their principal, settle a delinquency for a discount so they can stay in their homes. If the home's already vacant or they don't want to stay, then we offer them cash to cooperate with a deed in lieu or a short sale. By far and away, we do our best when we get a consensual resolution. And by doing that, those discounts not only generate great returns for our investors, but also provide transformative financial solutions for these families. So right now we're offering in our 2015 A plus offering, and let me just go forward. Hold on one second. Okay, so here's an overview. We started out as a nonprofit organization in 2008, and our mission was to help families at risk of foreclosure stay in their homes. Now we've evolved into a for-profit investment fund, but we still have the same mission to keep families at risk of foreclosure stay in their homes. And what we've evolved into is a nationwide buyer of these non-performing mortgages. Again, lower balance. So we're typically, these loans that we purchase are secured by homes with values of $75,000 and less. We sometimes also get higher value loans, but those are typically ones that have issues. Maybe there's missing documentation or some APR calculations were done wrong. If we can get them at a good enough discount, we'll go ahead and purchase those as well. People often ask, hey, this crisis happened almost 10 years ago. Are there really that many non-performing loans in our country? And the reality is it's still a huge market. There's over 300 billion in underwater mortgages. The vast majority became underwater as a result of the housing crisis in 08 and 09. But those concentrations are now in those low to moderate income communities. In most of the suburbs and the higher value neighborhoods, there's been some appreciation over the last few years. Homes that were underwater 5 years ago now have equity, and some of those families have sold their homes and moved on. Others have been able to stabilize their jobs and start making payments again. But again, the crisis remains in these lower to moderate income communities. We have purchased more than 6,000 loans since 2011. We've averaged a return of over 20%. We've helped over 1,000 families stay in their homes. We've also, when we get a vacant home, a loan secured by a vacant home, we've taken more than 1,000 of those and gotten them back into service. Basically, they've been sold and then reoccupied. And so you think of some of these lower value
Hey, George,
homes.
can I interrupt real quick? Are you
Sure.
trying trying to move slides right now because I'm still seeing the same first slide, the American
Oh,
homeowner.
really? Okay. Oh, I am. I moved 2 slides ahead. You
That's
don't see
odd.
that.
Yeah, yeah.
Oh,
Uh, Phil, can you help us here, Phil?
Yes, George. Just try to turn the screen sharing off and on again.
screen sharing right at the top. Let's see. Um, show taskbar. Okay, let's see. You know, those little icons are no longer there. Do you know why that is?
The icons should still be there.
Oh,
Just
display settings. Let's see.
if you just scroll around there, sometimes they might just disappear because and
They
then
go into
maybe
hiding.
yeah.
Let's see. Okay. We have, here's where we started out.
It's the third one on from the left.
Okay, so if I change that, did that just change it?
I don't
No.
see anything different.
Yeah.
Huh. Let me end it and
Oh,
let me
there you
There
go.
you go.
It moved.
Okay, I just changed. Now, how do I get back to, okay.
Now it's moving. Now it's moving.
Is it moving?
Yeah, so now it's back on the American Invest Today www, that one.
Are you doing this full screen?
Yeah, is that a problem?
Yeah. Try to leave full screen.
Okay,
Yeah.
so
Yeah.
does it
Just do
show
it like
overview
that.
now?
Yeah, it was moving.
Yeah.
Okay, so everyone, you see overview founded on a simple mission?
No,
No.
this one we see. We hope you'll.
Oh yeah, okay, I got it. Okay, I think we have it.
Okay, there now we see overview.
No.
Okay.
There we go. Yeah.
Okay, so I apologize to everybody for my technology challenges. I'm pretty
Yeah,
good
no problem. Let me just summarize something for everyone because I think everybody knows it, but you know this stuff so well, George, and I want to make sure everybody understands. So what we're talking about here is George's company. What they do, American Homeowner Preservation, is they go to larger institutions, banks, hedge funds, or whatever, and these banks and these institutions, they've got these failing mortgages on their hands. What's what we call notes. And they don't want them there, right? That's not what they're in the business of doing. They're not interested in it. So in order to get them off their books, they're willing to sell these things for pennies on the dollar. And that's where a group like American Homeowner Preservation comes in. And they used our, investor money, investors to leverage into buying these things. And in fact, at that point, George's company turns around and turns them, into. And he'll tell you how they do that, but they turn them into mortgages that people can pay and make a profit. I just wanted to kind of give a broad overview on that, just for people who weren't entirely sure what we were talking about.
I appreciate that, Buck. Yeah, sometimes I do this every day, so sometimes I don't realize that it's kind of a complicated thing that we do. Once you break it down, it gets pretty simple, but it's an unintuitive. When I first started this business, you say, okay, well, this person owes Bank of America $100,000. Now, Bank of America sells that loan to a group like us for $10,000, but you can still collect 100. The people still owe you 100,000. It takes a moment to realize how all this stuff works, but it is something that over time we've become pretty good at it. I mean, to the point where we've eliminated more than $100 million in negative equity. We've been able to just write off and still generate great returns. And in fact, on an annual basis, homeowners pay $4 million less on their monthly payments than they did before HP was involved in their mortgage. So it's a pretty significant financial transformation that we can deliver to these homeowners. So let me tell you about the pool that we're working on right now. This is something we need to close by the year end, and this is we're buying 458 loans for just under $10 million. It's 9.86. And here's a breakdown. These mortgages, on average, the families owe $55,000. The principal balance, if you combine them all up together, the 458, it's just over $25 million. On average, we're acquiring these loans for $21,000. The average home value is $52,000. And here, so all those things are pretty common. Those are numbers that are in the range of what AHP usually buys. Our average value hovers around $40,000. But what is not typical in this particular pool is the last icon there, where 32% of these families are less than 6 months delinquent. So these are families that, despite the crisis, despite the downturn in the economy, have by and large stayed up to date. They're running a little bit behind, 3 months, 6 months behind, but they're not 3 years or 6 years like we often buy. So that means these families, we are very optimistic that many of these families will be able to get a hold of them, get them on a payment plan to catch up, and then they'll, whatever we have to do to get them to catch up, and then they'll be able to pay on an extended basis and stay in their homes. So we're really excited about this particular pool for that reason. And to give you a little history of these loans were originated by City Financial or Associates Financial. Associates was later purchased by Citi, and they were and they've owned these loans for years. These are many a times loans that were originated in the 90s or the early 2000s, well before the crisis. And now City Financial has finally gotten to the point where they're selling huge amounts of these loans. And in fact, the hedge fund that we're buying these from bought these just a couple months ago. They bought 20,000 loans from City Financial. And they came to us about a month ago and said, hey, they took out the lowest value, the 1,000 loans with the lowest values, and gave them to us and said, hey, review these and let's try to work out a deal. And so far, we've reviewed the majority of them. They've agreed to sell the 458, and then there's probably another smaller pool that we'll buy sometime next month that we're still completing our reviews on. But that's how these loans ended up here. But we're really excited about the fact that so many of these families are not very far behind. It's refreshing to see, and it looks like our job will be a little easier than it usually is. Now, this particular slide will give you a real life situation. This is in Maywood, Illinois, just a little bit outside of Chicago. It's really part of Chicago, and a real true story, and you'll see some real numbers. So this gentleman took out a loan for $164,000 in 2003. In the file when we bought the loan, there was an appraisal in there from 2007, which is for many neighborhoods was kind of the peak of home values. And that appraisal was for $200,000. Now, we all know what happened after in 2008. The America's economy had significant challenges, and the property values decreased across the country. But not only did this property value decrease, but in 2010, for this particular family, the homeowner was laid off. He had a job for 17 years delivering water, kind of like in our office every week. Someone comes in with these big jugs of water, and that's what we drink all week. That's what he did for 17 years, and then he was laid off in 2010. So not only had his property value decreased, but he had also lost his job. So he fell behind on his payments, which were over $1,000 a month. And by 2012, Ocwen was the servicer. They started foreclosure. Now, at that point, the property was valued at only $32,000. So picture that. It went from $200,000 to $32,000, and this family was unable to pay. So they applied for a modification from Ocwen. Ocwen, after an extended period of time going back and forth on their documents, they eventually denied the modification and scheduled a foreclosure sale. Now, the good news is that loan was sold to American Homeowner Preservation in January of 2014 for $9,600, which is 30% of the $32,000 value. So we bought the debt, which was over $164,000 with all the delinquent payments, for $9,600. And here's what we did. We went to the family and we said, what do you want to do? If you want to stay, we can offer you a modification. And what we did was we said, pay us $2,000, and they owed over $20,000. We wrote off the difference, completely forgiven. Just give us $2,000 and you're up to date. And your old payment that was over $1,000, we'll drop it to $320. Now, when we first contacted this family, the gentleman thought it was a scam, thought it's too good to be true, this can't be real. But when he finally came around and believed, hey, we actually own your loan, he went ahead and did the modification. And it almost seemed like we'd gone back to our nonprofit days, like we were a charity again, because the payments were so, it was just such a transformation. But look at the numbers, because this is clearly a for-profit transaction. We put out $9,600. We got $2,000 right back within a couple of months to cure the delinquency. We then, in that first year, received 10 payments of $320. So total cash in of $5,200 on a $9,600 investment. That's a 54% return in the first year. For the next 18 years, there are 18 years left of payments on that loan. $320 a month, $3,840, 40% return for the next 18 years. So clearly, I mean, within just over 2 years, we'll have our full investment back, and then we're just, for the next 17 years, we just continue to collect payments. So really, financially rewarding, but also for this family, they were just thrilled with the results they got. So this is what we do, and it works extremely well, and the homeowner wins, the investors win, we have a profitable business, it all works. If you are interested in investing or simply learning more, our website is ahpfund.com. You can go on there, you can register, it's free to join, you can cancel at any time, and there's no membership or cost or anything on an ongoing basis. The minimum investment is $100. So you can invest $100, $1,000, $10,000, $100,000. Whatever amount you invest, you're treated the same as any other investor. So we have some institutional funds that invest, and they invest hundreds of thousands, and they get the same deal as an investor who invests 100. And that return, we distribute a 12% return. It's paid out 1% per month on roughly the 10th of each month. And that's what we pay. It's a significant return, but we generate significant returns from these transactions. How does that money get used? To just reiterate, we use any amount that you invest will be utilized to purchase pools. In this particular case, we're working on these 458 loans. We'll then work with the families to find some sustainable solutions that work for them. If they want to stay, they get to stay. If they don't want to stay, we'll do a deed in lieu or a short sale. You then receive your returns from these profits of these transactions, whether they're modification payments or we sell a property as a result of a deed in lieu or foreclosure, whatever revenue comes in, that's what we utilize to pay the returns each month. And this all works because we buy these loans at such significant discounts. And just looking at that example before, 30% of what the property is currently worth is not uncommon. We will purchase anywhere from 15 to 50%, and it's typically in that 30 to 40% of the current value of the home. So oftentimes, based on what they owe, they often owe double. These homeowners often owe double what their properties are worth. So we're buying that for 15, 20 cents, sometimes even less of what is currently owed on the home. Now, these are modest homes. Again, home value is typically under $75,000. Across the country, you can see there's homes in New York, Ohio, Texas, Pennsylvania, North Carolina. In fact, we purchased loans secured by homes in every state of the union, plus DC, plus Puerto Rico. The only state we haven't purchased in is Wyoming, and we hope eventually we'll buy one there. It's just a very lightly populated state, but surprisingly, I think to some, is we bought a significant number of loans secured by homes in Alaska. We likewise for Puerto Rico, and we even bought a loan last year secured by a home in Hawaii. So this is truly a nationwide problem, and it's truly a nationwide opportunity. And many of these families were hit hard by the housing crisis and have never recovered. But there's also a lot of families who survived the housing crisis of a decade ago, yet later on they got hit by an unexpected medical expense or medical emergency, a divorce, a death in the family, any number of job loss, any number of reasons which would have contributed to them all of a sudden getting behind on their mortgage and becoming at risk of foreclosure. Now, the good news for those families is when they do fall behind, that's when the banks look to sell their loans, and that is when AHP has the opportunity with our investors to get involved. Why should you consider investing? Big reason is anyone can invest. Before mid 2016, we could only accept investments from accredited investors, basically wealthy investors. But in 2016, we were qualified by the Securities and Exchange Commission to offer under Regulation A+, which basically allows us to offer our investment opportunity to anybody, non-accredited and accredited. The only caveat to that is for non-accredited investors, they can invest a maximum of 10% of their annual income or 10% of their net worth, whichever is higher. For accredited investors, can invest an unlimited amount. To reiterate, the minimum investment is very low, very, very low for this industry. I think we're amongst the lowest. $100 is welcome. Most other funds are at $500 or $1,000 or even $5,000. We want to make it as accessible as possible to anybody. So you invest $100, maybe this sounds interesting, but you're not sure if you really want to commit. So investing $100, you kind of get exposed to how this all works. And then in the future, you could put in 1,000, 5,000, 100,000, whatever number you feel comfortable with. But that's one of the reasons why we set the minimum so low. You can take a look at our audit. Our audit, we're required to file audited financials with the SEC each year. Our first year of operation was 2016. We earned a 39% return and we paid out 12% to investors. Those audit results are on our website, again at ahpfund.com, and also on the SEC's website. Now look at that. We earned a 39% last year and we paid out 12%. So investors get their returns first. So here's how the money flows. If we generate, that first 12% goes to investors. If there's extra money, then we utilize it to purchase additional mortgages. And since this fund is for 5 years, it's a 5-year investment period. We expect for the first 2.5 to 3 years, what we will do is we will continue to reinvest any extra money. And at the point, more or less in the 2.5 to 3 years, we'll say, okay, we're going to stop reinvesting this money and we're going to start returning the extra capital to investors with the goal that at the end of the 5th year, all investors have received all their money back. And then whatever's left is ours. That's basically our profit. So we want to do is pay investors their money back, their original capital, plus their 12% return. And once we've accomplished that, whatever's left is ours. And you can actually see this in our financials, in our the semi-annual financials, which were good through the end of June, reflected that the accumulated profit, this is that money that's being reinvested, was almost $1 million for the first year of operation. And that's continued to grow. So that is, that's our incentive, and our interests are aligned. We want to get you paid your 12% and get your money back, and then we reap the rewards at the end. The social impact, we always keep this at the forefront. Our mission is to work with these families to find sustainable solutions, which in many cases banks or prior servicers were unable or unwilling to consider. In all cases, we will do whatever we can. If a family wants to stay in their home, to help them stay in their home. We are well aware that if you end up in battle with a homeowner, and there's many cases this happens, especially with the big banks, where they end up taking steps which are adversarial to the homeowner, and let's say an investor or the bank decides that they want to kick this family out, foreclose and kick the family out, and the homeowner decides, no, I want to stay, then they end up in court and no one wins. So if the homeowner wants to stay with us, they can stay. If they don't want to stay, then we're going to help compensate them to exit as fast as they can. So we try to always strive for the consensual solution and achieve a significant social impact. And although our fund is a 5-year term, there is best efforts liquidity, which basically means you can give us 30 days notice, and we will do our best to liquidate your all or part of your investment within that 30 days. And we've had a few investments redeemed in the first. This has been our first 1.5 years of operation in this fund, as well as in prior funds. We've always been able to meet it within the 30 days. The only caveat to that is if the investment is liquidated in the first 6 months, the return drops from 12 to 10. And if it's in the second 6 months, it drops from 12 to 11. After a year, if you liquidate it at any time, you get to keep your full 12%. So we hope this was informative to you. And you'll consider helping to fund these 458 mortgages, which we're trying to close by the end of the year. The goal is to keep these families who are wondering whether this will be their last holiday season in their home, to help keep them in their homes and also generate good returns for you, our investors. Again, our website is ahpfund.com, and I'd love to hear any questions that anyone has.
Yeah, so if this is Buck, if everybody, it'll take a minute. I'm going to ask George a bunch of questions while we wait. If everybody wants to write down your questions in this chat box, then we'll kind of circle back. But George, let me just say a couple things and then ask you a few questions too.
Mm-hmm.
First of all, going to get a great business, and I've always been a big fan. Couple things to note, I think that are really important from an investor standpoint. The last fund had a 39% return on audited financials. So George giving us 12% is not a high hurdle. One of the things, the other thing I wanted to point out is you talked about liquidity. In my experience, and I've been a six-figure investor with George for some time, and I've never had any problem getting my money back very, very quickly. So I just want to, kind of vouch for him on that end. I don't have any financial interest in American Home Preservation. I'm just, they are a sponsor, but they're really a business that I have liked for a long time. George, a lot of questions come up from people on a regular basis. And I'm going to ask you some of those, even if I kind of know the answer myself. But first question, a lot of times the questions I get from people when they ask me about what I think is, well, what happens when times get tough? What happens if there's another 2008? My instinct is that your business would actually get better, not worse. But tell me what the realities are for that kind of thing, because I think, many of us are looking at the economy thinking there's probably some bubble economics going on there right now, and that there may be some correction. How does that affect, people who are currently invested? And give us some scenarios in which, you think how you think that it could affect investors.
No, it's I think we'll do extremely well, as you speculated, in a downturn. We have two things are going to happen. One is the holdings in our current holdings may drop in value, and they likely will drop in value by a modest amount, though, because remember this is you look back on history, and there's this cycle to the real estate market, and in this cycle there has been a significant appreciation, but it's really accrued to the homes in the higher value neighborhoods. These homes that we're working with, by and large, have been left behind, unfortunately. And so a home that was worth $50,000 3 years ago is probably worth $50,000 today, whereas a home worth $200,000 3 years ago could be worth $250,000 today. So the good news is, because they haven't gone up in value a lot in this cycle, they probably won't go down significantly either. So although there may be some modest drop in value on our existing holdings, I don't think it'll be very significant to impact operations. I mean, the reality is, if someone owes us $100,000 and their home is worth $50,000, and we come up with a solution that keeps them in their home at half their prior payment, I don't think they really are going to mind whether their home is now worth 50 or 40. It's going to be pretty much the same to them. In most cases, what we offer in terms of a mortgage payment is cheaper than rent. So it really just makes a lot of sense. But the flip side of all this is the opportunities. The number two is that the opportunities for us to buy would significantly increase. Whenever a downturn happens, people start running. away from these types of investments, be it homes, real estate, commercial properties, multifamily, notes that are secured by those types of properties. People just either sit on the sidelines or they run from them. And so you always want to be running the other direction from the crowd. So when people run away, we run too. And hey, the real estate market is collapsing or declining. That's the time we'd want to be running in, saying, hey, let's buy these notes, because the competition will diminish significantly. And I'll give you a really good example. When we first started in 2011 was the first time AHP ever purchased a mortgage. And we were within 6 months of starting to buy loans. We were buying from some of the biggest banks in the country directly, from Citibank, from Banco Popular, from FDIC, selling to us. And we hardly knew what we were doing. And but over time, for instance, Citibank won't sell to us. And it's nothing like we're still friends, but right at that point, we were buying like 500,000, a million, 1.5 million, really small numbers, but there weren't that many buyers. So Citibank was willing to sell to us directly. But today, fast forward, and there's just a ton of other buyers for notes. And so Citibank generally won't do small trades. So instead, they sell to the group that we're purchasing from right now, which is called Rock Top. They'll sell them 20,000 loans, which was probably several $100 million, or I'm not even sure what the number, but it was a significant number, certainly well over $100 million that they traded these for. They sell all those loans to this hedge fund, and then the hedge fund goes ahead and cuts these out and sells them to us. But it is, I expect when this downturn happens, we'll be back dealing directly with Citibank, because some of that big money will go to the sidelines. And that's what's really exciting. And I see the opportunities for growth, both in just scaling our business, and also scaling the opportunities for our investors, and scaling our impact on struggling homeowners will all grow significantly in a downturn. So sorry if that answer was a little bit long, but it is something that gets me excited. Once this happens, and it's going to happen, when it happens, I think I want to be as well positioned as possible to take advantage of the opportunities to both grow our business, generate returns for our investors, and impact families.
Hey George, why do these larger players step aside when it seems like the opportunity is greatest?
Yeah, that's a good question. It's a good question for Wall Street. There's today, I think everybody's chasing real estate or these notes. I mean, I guess the question is, why is everyone doing that? Probably the reason is that there's a lot of liquidity, there's a lot of money flowing in, so everybody is thinking, hey, there's credit that's cheap, let me take advantage of that. There's just a lot of money that's sitting around that can be deployed, and people are looking back, a year, 2 years, 3 years, and saying, hey, the last few years there's been an average of 8% appreciation in this market, so that'll probably continue. If it's been going that way for the last 3 years, it'll probably continue, which is probably not a good analysis, but it's nevertheless is an accurate analysis. But as soon as the market turns, people do tend to say, wait, credit will dry up, because the banks and lenders will get concerned, and they're not sure which direction things are going, so they'll just stop lending, and then and then the opportunities just become much greater, and the bigger funds, I don't know, maybe they just don't turn.
Well, is there a different disposition that they do? I mean, so the way you guys work is that you turn around and, of course, you try to rent to own for the most part with these, or just try to, I don't know if it's a rent to own or if you're just
really modification of the loan.
Modification of the loan. Now, is it when your typical larger group comes in, and you guys are pretty big, it's not a small group, but are they mostly just trying to sell off the asset? And if they sell off the asset, obviously there's a depreciation, or that's where some of the vanishing equity actually makes an impact for larger investors, right?
Yeah, they're agreed. I mean, their strategies, I think they just have, I don't know why, but there's this playbook that it seems like everybody plays by, which is A homeowner wants a modification, you put them through a bunch of hurdles, a lot of bureaucracy, and then you come out with a decision, which most often is no, once in a while is yes. And then when it is yes, then the actual solution isn't that helpful to the homeowner in many cases. And so you look at that, and I don't know why it's like that, and I don't know why it's still like that, but that's the way it is for these big lenders. So we just make it much more streamlined. And then the next one is if it's a deed in lieu, you think everybody would treat a deed in lieu at Bank of America or a deed in lieu at HP, everyone's going to treat it the same, but it's not the case. I mean, here, if someone wants to do a deed in lieu at Bank of America, okay, well, we want your tax returns, we want your bank statements, we want all this stuff. And the homeowner's thinking, I'm just giving you the property. Why are you making me give you my bank statements or paycheck stubs? It doesn't make sense. Yet that's what they do. And then they mail the deed in lieu to the family. The family has to take it to a notary and then mail it back and sign a whole bunch of forms. And it's this tedious bureaucratic process. So let me give you how AHP does it. If someone wants a deed in lieu and they call in today and they say they want a deed in lieu, so we will prepare the deed in lieu. We'll overnight it along with a check to the notary, to a local notary. The local notary will go wherever they are, their home, their work, McDonald's, wherever they want to meet. They'll meet the homeowner. They show their ID. The homeowner shows their ID. They sign the deed in lieu. They get the check, and it's done. So if someone calls in today, it could probably be done in 48 hours. Now, if they call into Bank of America, it may be done in 6 months if everything goes well. So I don't know why they're so inefficient and bureaucratic, but it just they are. And when you see things like that, and it's so prevalent, everybody's using this outdated, stale, bureaucratic playbook, and we come along with this much more streamlined one. I don't know why other people aren't doing it, but I think in a downturn, we can upend these big banks and their inefficient procedures by delivering something that's just superior and simpler.
I'm going to start getting to these questions here. Question from Tony, Canadian investors. Any problem with that?
Canadians are welcome. In fact, all foreign investors are welcome.
Good enough. Let's see. Arthur says, how much competition is there to purchase these types of loans from banks?
That's a great question. And right now, there is some competition, but we're one of the only, if not the only, nationwide buyer of these mortgages that are secured by homes in lower to moderate income neighborhoods. There's plenty of regional and local buyers, but we're the only one that I know of who's just doing it on a significant scale nationwide. And then the big Wall Street hedge funds, they'll buy it, but they're looking for the higher value loans, not for these. So there is competition, and the fact that people are buying the higher value loans and they end up having to buy the smaller ones just to get what they want, that's what creates the competition. But just directly, someone saying, hey, I want to buy all loans under $75,000 nationwide, that's a market that we pretty much are a big player in.
Arthur, I think I know the answer to this, but I'll ask anyway. If I invest $20,000 and then 8 months later ask to liquidate $4,000, does the remaining $16,000 continue to earn 12%? The answer, I assume, is yes there, right?
Confirmed. The answer is yes.
Yeah. Anthony, how are you, Anthony? He says, how do you calculate when to return investor money when people choose to reinvest every month?
So you have the option when you make an investment to either reinvest or to get a cash distribution. That's your option. You can change it at any time. How do we calculate it? It's calculated the same. I mean, it's basically 1% of the investment. If you came in that month, there may be a proration for the first month, for instance, or the last month of your investment. But outside of that, it's 1% of the investment, whether it's reinvestment or cash distribution. If you do a reinvestment, we'll process it on the more or less the 10th, but it's effective as of the first of the month. So that reinvestment will get a full month's worth of returns.
Right. So basically, you have to be in the fund for, that your new money has to be in the fund for what, 30 days before it gets sort of, we get returns on it, or?
Yeah. So no, actually, if you were to invest today on the 19th, all the way up until the 31st of December, you would get a return on the 10th. Now, it may only be a few pennies because it's just a day, but it will be a prorated amount.
Arthur. Well, it says he's asking, how would rising interest rates over the next 5 years impact our investment? Is it possible that the returns would rise too? My assumption is not. We're talking about fixed interest rates here that we're negotiating, right?
That's absolutely right. That's absolutely right. So if the rates were to go from where they are now to 6 or something like that, we'd still be paying 12. It doesn't mean future offerings wouldn't be adjusted to if the market were to return, would have a different interest rate environment and that adjustment.
And Russell asked, what factors would cause the 12% investor return to change? Pretty much if for some reason you did not get 12% yield from your from the fund, correct? Is there any other?
Exactly. So if we were to earn 8% in a given month, and that's all we could return to investors, we would return 8%. Now the extra 4% would accrue and be paid in the next month that there were additional monies to pay the full 12% plus the extra 4%. So it's something that if we're unable to pay it, and our documents provide for this, because it could realistically happen. It hasn't happened yet, but in a significant disruption like 2008, maybe there was some impact on our cash flow, and we may not be able to pay when it's due on the 10th. But our expectation is at some point we'll be able to catch up and get everyone, the full 12%.
Russell's asking, can you invest from your IRA? The answer is yes. I know that's a yes, but it has to be a self-directed IRA. It can't be just any old IRA. And you guys actually help with that too if people don't have a self-directed custodian, right, George?
That's absolutely right. So if you have a custodian already, great. We can work with just about any of them. If you don't have a custodian, then we have some custodians that we can point you to as ones who are particularly familiar with HP's operations and can process the investment promptly.
Okay, and Roxanne, hey Roxanne, how are you? She asked, how does this fund differ from your previous funds? Is it any different, or does this look pretty much the same as the other ones?
Pretty much the same. I mean, to two parts of that question. One is this is the continuation of 2015A Plus, the fund that we've been offering since mid-2016. We'll continue to offer it through mid-2018. And so if you're investing in this fund, which is these new 458 mortgages, you're also investing in the other 1,500 or so mortgages that are already owned by this fund. Now, the question is going to prior funds. The prior funds were similar in composition in terms of what we purchased. They were just generally smaller.
Why doesn't AHP buy more of these loans? Well, they buy a lot of these loans. And what are the limiting factors? And I think my guess is money and time, right? I mean, that's pretty much it.
Yeah, money, time, and opportunity. So there is. Yeah. This is a frustration in the business in an up market. So it's not an unlimited number of loans we can buy. There's a disconnect between what the seller is willing to sell for and what we're willing to pay. So then we simply can't buy from that seller until they become aware that maybe what we offer is reasonable. So there's not an unlimited pool of these opportunities. We get them. We take advantage of them when we can.
Tony asks, how much of the investor's original capital is returned annually? The answer there, Tony, actually is none, right? I mean, it's interesting you asked that, Tony, because when I first started investing with George, he was returning capital, and I told him personally I didn't want him to return my capital because and I'm guessing that's what others told you too, because they were like, well, what are you sending me my capital back for? I mean, I want to invest with you, right? And so isn't that kind of what happened, George?
Yeah, exactly. So our first few funds, what we would do is we just raise the money and then we would stop. And then as money came in over and above the returns that we paid to investors, then we would just return the capital each month. So some people were getting paid off in 6 months, 12 months, 18 months, which they didn't like by and large. Maybe it was nice at the beginning because we are just kind of testing the concept. But as we've grown, it's clear that most investors want to put in and even reinvest those monies. But that's we swapped that kind of return of capital on a monthly basis with the ability to liquidate when you need to. And so most people don't want their money back, but then someone does need their money back. So that extra money that we would have in the past used to return to investors as capital, now we use to reinvest in mortgages, or if someone needs their money back, to redeem and get them, all or part of their investment back as needed.
Yeah, Tony, along that lines, the liquidity here is very high. So if you wanted your money back, you can get it. But I mean, I think one of the beauties of this is, from my perspective, is the ability to constantly reinvest it. And when you reinvest it, you're effectively creating a 12% compounding return. Actually, it's even better than 12% compounding, because if you do the math, it's actually 1% per month compounding, which is greater than an annualized 12%. George doesn't say that, but that's the math. Um, let's see here. Cody, well, the original capital is not secured by any collateral. Is that correct? Well, I think the collateral is all your real estate, right?
Sure. So we have the collateral. If you were to invest today, we in this fund right now, we have over 1,500 assets, which are mostly mortgages and some real estate REOs and whatnot. And so that's the collateral. Now the money will go into escrow, and then this money will be used next week to take that more or less 1,500 assets that we have to buy these 458 and make it all around 2,000 assets that we have. So it would simply add to that number. So today, if you were to invest, it goes into the escrow company, and then we'll utilize it next week to buy this pool.
Okay. Looks like that's Russ asked about where you get the 12% for, and I think Russ, George was generous initially, and then he made the market, and then once you say you're giving 12%, it's hard to tell people they're getting less, right?
That's pretty much true. Although I think the next fund we do may drop. Not for sure, but I'm expecting we'll drop to 10%. At this point we're still above market. There are other firms doing not exactly the same, but they're raising funds for real estate, and they're paying oftentimes 8 and 9, 7, 8, 9%, and here we are at 12. So we're a bit of an outlier. Generally we've done very well, so it's been easy to pay the 12. But as we grow, it probably makes sense to get close to the competition. So this fund will likely be our last one at paying the 12%, and we'll probably drop down to 10.
Oh boy, you heard that one here. You better get in on this.
Just to be clear, though, that's the 2015 A Plus fund, which will be open for a few more months through the middle next year. But this is we do think that the next fund subsequent to this will be 10%.
So Russ, I think you just got your question answers. Is there plans to increase to 12%? And the answer is going to be no. It's funny though, because we've got people here thinking 12%. Are we going to do better than that? This is. Let me tell you guys one thing that I think is really, really important. That as an investor, and I consider myself a sophisticated and experienced investor, and I have over the years probably invested close to $1 million with George. Okay. The fact that George is making 39% on these doesn't make me say, George, why are you not giving me more money? The fact that George is getting 39% and he's giving me 12 makes me feel like, oh, thank God George is making 39% because I'm making 12%. What he has is a business, and what we're doing is we're limited partners, and it's passive income. And from my perspective, and I'll just go on a limb and say, I don't know that I know of anything else that out there right now that's paying 12% on effectively what I consider to be some pretty high quality notes here. Not in everybody's hands, but George's track record and the numbers that he's pulling off, these hedge funds would not be paying you 12%. So just to be clear, I think it's kind of, we sometimes get into this world where we think these are normal numbers. They're not. So anything to add to that, George?
No, I agree. It truly is passive. People do hard money loans like directly and get, sometimes get 12%. They can do some type of real estate investment and sometimes get 12%. But here, the difference is here, it's truly passive. You can go in, you can invest online in just a few minutes. If you need your money back, you can request your money back, and based on history, you'll get your money back within 30 days. So that's much more it's very, very hands-off, and we try to make it as easy as possible to investors. And here's probably the best thing in it. The reality is we lose money on individual loans. If we buy 1,500 loans, we buy I think 1,800 loans in this fund, there's a good chance that we're going to lose on anywhere from 5 to 10% of them. But we more than make it up on the rest of them, and that's where I think the you have this. It's much easier than saying, "Hey, I'm going to go out and buy notes myself and try to figure out." There's definitely money to be made. I mean, we're proof of that, but it is a lot of work. And if you buy 1 or 2 loans and 1 or 2 of those turns into a loser, that's probably the last time you're going to buy notes. So that's just something to be aware of. I mean, the fact that we're spreading the risks of this business out over so many assets, I think is a significant value to investors because we are able to pay the 12% and absorb the few losses that we have, and then reap the rewards on all the wins, whether they're big or small.
And just as a corollary to that, because I think this is really important, because this is why I like this fund, right? And again, I don't own any part of this fund. I don't, what George raises has nothing to do with me, but I just feel it necessary because I feel like sometimes people tell me about how they're getting 12, maybe they're getting more than 12% on hard money loans to flippers. My friends, that is a completely different ball game in terms of risk profile, especially right now when you're in a real estate bubble. To sit there and lend to flippers who are going to give you 12 or who are going to give you 14%. Well, guess what happens when the market turns, when the only ththing that you're expecting is appreciation? Then it's a game of musical chairs, and whoever, you're going to lose. You're going to lose on that if the market turns and your money's in the air. This is a completely different ball game, and what I like about it is that, as George very appropriately pointed out, this is a business that, first of all, is not easy to do. I mean, it's effectively George's background as being like a D class multifamily real estate investor helps him a lot to this. So this is not easy work. But on top of that, so they're really good at this. And then the pure volume of the number of loans that are in it create a level of stability and security that's not available in most other hard money loans. And then finally, when the economy turns, this business gets better. Unlike the hard money loans that people always tell me about, which I have no interest in, that when the economy turns, they're going
to. Yeah, no, I agree. I think. Buck? Oh, it sounds like we lost Buck. Okay, so we may have lost Buck, or at least I can't hear you. I'm hoping people can still hear me. But in closing, yeah, I think
I can hear you, George.
Oh, good. Okay, for a minute it went out. Okay.
And a couple more real quick questions.
Okay, sure.
From people here. What sort of tax form do they get? That's Arthur.
K1. You get a K1, and the gains will be a mix of ordinary income and capital gains, both long and short term. In the latter years of the fund, it'll probably be just ordinary income and long term capital gains.
What happened? Well, let's see. The tax burden, Anthony. I think that answers your question. There really is no strategy to minimize tax burden here. It kind of is what it is, depending on when you get the income, whether you get it in the first year or the second year, right? Isn't that effectively it?
Correct. And remember that the gains are based on what the fund earns. So if you invest today, then even though your investment has only been out for a short period of time, next year when you get a K1, that K1 could have long-term capital gains because the fund earned long-term capital gains, and that simply flowed through to you as the investor. It's not just people are sometimes confused. Well, I was only in, I just invested in December. Why am I getting long-term capital gains if I've only been in the fund for a month or two? And the answer is it's based on the fund. So keep that in mind. Either way, it's like Buck said. I mean, there will be likelihood of tax liability, but as there is or should be with any type of earnings. The good news is here is you're getting a significant rate of return, which should make paying taxes that much easier.
Arthur had a good question with the IRA. I mean, you're not using leverage to buy these, right? I mean, you're buying them cash. I mean, so there's no UBIT.
Yeah, so UBTI is we have historically used leverage on a short-term basis. When we need to close a large pool, we've used it, I think, twice so far. We could use it in the future. We've never crested that threshold of, I think UBTI, it's 1,000 per investor, I believe. We've yet to crest that, so we have yet to generate UBTI. But I can't say that that's forever going to be the case. Historically, we have not generated enough for any investor to pay UBTI.
There's one last question here, Anthony. It's investing through an LLC or corporation under the new tax bill. I don't know if that's a question for George as much as it is a tax question. I will tell you that I think that there is, if it's not service oriented, it's a pass, at least from what I'm understanding. If you are investing through an LLC and it's passive income through an LLC, there is an opportunity potentially to deduct, I think, up to like 21% of the gains or something like that. But I don't know that George would have that answer, unless, George, you have some, special tax knowledge in terms of this tax bill. But
I don't. The only thing I can say is, we certainly welcome all forms of investment entities. So it could be an individual person, could be a couple, as a joint account, it can be an IRA, it can be a 401k, it can be an LLC, a corporation, a trust, a UGMA, Uniform Gift to Minors Act. So we're very flexible in accommodating pretty much the spectrum of vehicles that investors choose to invest in. But as Buck pointed out, it's probably best to consult with a tax advisor to advise which is the best structure if that's something that's of concern.
Yeah. Well, George, this has been great. I just, again, want to just say I think this is a great business. I think it's a great opportunity, everyone, especially if you want to do something that is socially responsible and you can feel good about your money. I personally will be investing somewhere between $200,000 and $400,000 in this fund. So that, again, that's mostly just to show you, not to, other than to say that, I wouldn't have a guy like George on here talking about this stuff if I didn't really, believe in what he does. So, and of course you can invest $100, and my 8-year-old actually might be investing $100 in this, George. So she's going to.
I appreciate that. Just like, that's a good point. So an 8-year-old, actually, we can only take investors who are 18 years of age or older, unless you do it as a UGMA, Uniform Gift to Minors Act, or UG. The TA. So you can do it. It is very, very easy. It's actually, we've automated to some extent, or we're in the process of automating it, but we can definitely accommodate that. So 8-year-olds are fine as long as they're investing, as long as their parent is part of, or custodian is part of that transaction.
Well, you could do it as a trust, right? She has a trust.
You can also do it as a trust.
Right. There you go. Right. But then she'll be upset because she won't be able to access it. But all right. Well, thanks again, and it was great. And everyone, if we want to get in touch with George, there's ahpfund.com. You can go there and invest directly. If you want to talk to George a little bit more personally and you're thinking about investing, George has really been great about talking to our investors. And shoot me an email at buck@wealthformula.com. By the way, let me tell you about the money that I'm investing in George's fund, because I think this might actually be interesting to some of you who are using the same strategy. I'm using money right now from my my Wealth Formula banking account. So as a lot of you know that, I'm a big advocate for this type of, product where you can basically, take your money, this that's growing at a compounding rate, and then borrow it at a simple rate and then deploy it somewhere else. And effectively, you'd be getting 12% from George's fund, but then you'd be getting this compounding interest at the same time still from your Wealth Formula banking account. I know a number of those listening already have those kinds of accounts, but this is a great strategy for that, because from my perspective, I'm going to get 12% from George and at the same time continue to get a compounding return on the other side. So that's another great option for this. But I'll leave you with that. And if you want to talk to George a little bit more, or me, ask me questions or whatever, you can also email me at buck@wealthformula.com. Okay, thanks again, and that's it for tonight.
Thanks, everybody.
Bye-bye.